Look, I need you to pay very close attention to what I'm about to tell you, because what's happening in the silver market right now is something most people won't see coming until it's too late. And if you're holding physical silver, or if you've been thinking about it, the next few weeks could determine whether you're positioned for one of the most significant wealth transfers in modern history, or whether you're left watching from the sidelines. Let me start with something that happened just last Tuesday that should have made headlines everywhere, but somehow got buried in the financial press. The COMX silver warehouse stocks dropped by 2.1 million ounces in a single day. Now, if you're not familiar with how this works, let me explain why that matters. The COMX is where the paper silver market operates, where futures contracts get traded, where the price you see on your screen gets determined. And those warehouse stocks? They're the actual physical metal that's supposed to back up all those paper promises. Here's the thing, though. There are currently 430 million ounces worth of open interest in silver futures contracts on the COMX. But the registered inventory, the silver that's actually available for delivery, sits at just 47 million ounces. Do the math on that. That's a ratio of more than 9 to 1. 9 paper claims for every single ounce of physical silver that actually exists in the warehouse. And it's getting worse by the day. I want you to imagine something for a second. Imagine you're at a bank, and that bank has issued deposit slips to 10 different people, all claiming they have $100 in their account. But when you look in the vault, there's only $100 total. Everything works fine as long as only one person shows up to make a withdrawal. But what happens when 2 people show up? What happens when 3 people show up? What happens when all 10 people show up at the same time demanding their money? That's exactly what's building in the silver market right now. And the people who understand this, the smart money, they're not waiting around to find out what happens when everyone rushes for the exit at once. Let me tell you about a guy named David. David's a portfolio manager at a mid-sized hedge fund in Connecticut. Nothing flashy, manages about $800 million in assets, mostly for high net worth individuals and family offices. 3 months ago, David started noticing something strange in the silver market. He was trying to take delivery on a futures contract, something he'd done dozens of times before, and suddenly, he was getting pushback from his broker. Not a hard no, just friction, delays, paperwork issues, requests to roll the contract forward instead of taking delivery. David's been in this business for 23 years. He knows what friction means. It means someone doesn't want you to have the physical metal. So he started digging deeper, making calls to his contacts at the bullion banks, talking to people at the refineries, reaching out to dealers he'd worked with for years. And what he found out made him completely restructure his entire precious metals position. The refineries are running at full capacity, but they can't keep up with demand. The mints are rationing supply to dealers. The dealers are extending delivery times from 2 weeks to 6 weeks to 8 weeks. And the premiums, the amount you pay over spot price to actually get your hands on physical silver, those premiums have gone from $2 an ounce to $7 an ounce in some markets. In some cases, even higher. David told me something that stuck with me. He said, when the paper price and the physical price start diverging like this, when you can't actually buy the metal at the price you see on the screen, that's not a market anymore. That's a mirage. And he's right. Because here's what most people don't understand about how silver gets priced. The price you see, the spot price that gets quoted on CNBC and Bloomberg and every financial website, that price isn't determined by people buying and selling actual silver. It's determined by people trading contracts, derivatives, paper promises of silver. The actual physical market, the market where real metal changes hands, that's a completely different animal. And right now, those two markets are telling very different stories. In the paper market, silver's been trading in a relatively tight range, bouncing between $28 and $32 an ounce. Volatile, sure, but nothing that would make you think something fundamental is breaking. But in the physical market? In the physical market, you've got premiums exploding, delivery delays extending, and an increasing number of situations where dealers are simply saying, we don't have it. We can get it, but it's going to take time. Now, why is this happening? What's driving this disconnect? Let me walk you through the supply side first, because this is where things get really interesting. Silver production peaked back in 2016 at about 900 million ounces per year. Since then, it's been declining. Not dramatically, but steadily. We're now producing about 830 million ounces annually from mining. And here's the kicker. About 70% of silver production comes as a byproduct of mining other metals. Copper, lead, zinc, gold, which means silver production is largely dependent on the economics of those other metals, not on the price of silver itself. So, even though silver prices have been rising, we haven't seen a corresponding increase in primary silver mining. Because it's not economically viable to open new silver mines at current prices, the cost structure doesn't work. You need silver at $50, $60, $70 an ounce to justify the capital expenditure of opening a new primary silver mine. And we're nowhere near those levels yet. But demand? Demand is a completely different story. Industrial demand for silver hit a record high last year, 654 million ounces, and it's projected to go even higher this year. Solar panels alone are consuming about 140 million ounces annually, and that number is growing at 15% per year as countries around the world accelerate their renewable energy buildouts. Electric vehicles use about twice as much silver as traditional cars. 5G infrastructure requires significantly more silver than 4G. The electronics industry, the medical industry, water purification, you name it. Silver demand is increasing across virtually every industrial application. Then you've got investment demand. And this is where things get really interesting because investment demand is incredibly price sensitive. When silver starts moving, when people start paying attention, investment demand can spike dramatically. We saw this in 2011 when silver went from $18 to $48 in a matter of months. Investment demand went absolutely parabolic. We saw it again in 2020 during the Reddit silver squeeze, and we're starting to see the early signs of it happening again right now. But here's what's different this time. This time, you've got central banks entering the equation. Now, central banks have always been big gold buyers. That's nothing new. But silver? Silver's been largely ignored by central banks for decades, until recently. In the last 18 months, we've started seeing reports of central banks, particularly in Asia and the Middle East, quietly accumulating silver. Not in the massive quantities they buy gold, but enough to be noticeable, enough to matter. Why would central banks suddenly be interested in silver? Because they're looking at the same supply and demand fundamentals everyone else is looking at, and they're realizing that silver is potentially the most undervalued strategic metal on the planet. It's essential for the energy transition. It's essential for military applications. It's essential for electronics and technology, and there's not enough of it to go around. Let me give you some context on just how tight this market really is. The entire above-ground supply of silver, all the silver that's ever been mined and still exists in some form, is estimated at around 2.5 billion ounces. Sounds like a lot, right? But compare that to gold. There are about 6 billion ounces of above-ground gold. Gold, which is far more abundant in terms of existing supply, trades at 85 times the price of silver. The gold-to-silver ratio is currently sitting at about 85 to 1. Historically, that ratio has averaged around 60 to 1. And if you go back further, if you look at the ratio over centuries, it's been closer to 15 to 1. Now, I'm not saying we're going back to 15 to 1 anytime soon, but 85 to 1? When silver is becoming increasingly critical for industrial applications while gold sits in vaults doing nothing, that ratio is telling you something. It's telling you that silver is either dramatically undervalued or gold is dramatically overvalued, or some combination of both. And the smart money is betting on silver being undervalued. I want to tell you about a conversation I had with a guy who runs a family office in Singapore. This family office manages about $3 billion for a single ultra-high net worth family. Old money, very conservative, very risk-averse. The kind of people who don't chase trends or get caught up in hype. And 6 months ago, they allocated 8% of their portfolio to physical silver. Not silver ETFs, not silver mining stocks. Physical silver, stored in allocated accounts in Singapore and Switzerland. I asked him why. Why silver? Why now? Why physical? He said something I'll never forget. He said, "We're not buying silver because we think it's going to double or triple. We're buying silver because we think the current monetary system is going to have a very difficult time over the next decade, and we want to own things that have intrinsic value, that can't be printed, that can't be debased. Gold is obvious. Everyone understands gold. But silver? Silver is gold's little brother that nobody's paying attention to. And when people do start paying attention, there's not enough of it to satisfy demand." He continued, "The thing about silver is that it gets consumed. It gets used up in industrial applications, and it's not economically viable to recycle it in most cases. So unlike gold, where almost every ounce ever mined still exists somewhere, silver is actually disappearing from above-ground stocks. And at some point, that's going to matter. That's going to matter a lot. And he's absolutely right. Silver recycling rates are relatively low compared to gold. When silver gets used in electronics, in solar panels, in medical applications, most of it doesn't get recovered. It's gone. Which means the above-ground supply of silver is actually shrinking while demand is growing. Now, let me talk about something that most people don't think about when it comes to precious metals, and that's the role of leverage in the paper markets. Because this is where things could get really explosive, really fast. The silver futures market operates on leverage. Typically, you can control a 5,000-ounce silver contract with about 10% margin. So, if silver is trading at $30 an ounce, that's a $150,000 contract, but you only need to put up $15,000 to control it. That leverage works great when prices are stable or moving in your favor. But when prices start moving against you, when volatility picks up, that leverage becomes a massive problem. And here's what's happening right now. The commercial traders, the big banks that operate in the silver market, they're holding a near-record net short position. They're betting that silver prices will go down, or at least stay contained. But the speculative traders, the hedge funds and commodity trading advisors, they're increasingly going long. They're betting that silver prices are going higher. This setup, this positioning, it's like a coiled spring. And all it takes is one catalyst, one event that forces those commercial shorts to start covering their positions, and you could see a price spike that makes 2011 look tame. What could that catalyst be? Well, there are several possibilities. It could be a major industrial buyer deciding they need to secure physical supply and going into the market aggressively. It could be a geopolitical event that disrupts supply chains. It could be a major mine closure or production disruption. It could be a sovereign wealth fund or central bank making a large purchase. Or it could simply be a technical breakout that triggers algorithmic buying and forces short covering. The point is, the market is set up for a significant move. And when that move happens, if you don't already own physical silver, you're going to have a very hard time getting it. Let me tell you what happened in March of 2020, during the early days of the pandemic, because it's a perfect example of what I'm talking about. Silver prices crashed from $18 down to $12 as everything sold off in a panic. But here's the thing. You couldn't buy physical silver at $12. You couldn't buy it at $15. Dealers were sold out. Premiums spiked to $8, $9, $10 over spot. So even though the paper price said silver was $12, if you actually wanted to buy a silver eagle or a silver bar, you were paying $22. And that disconnect lasted for months. The paper price recovered relatively quickly, but the physical market stayed tight, premiums stayed elevated, and delivery times stayed extended. Because once the physical metal leaves the market, once it goes into strong hands, people who are buying to hold, not to trade, it doesn't come back. It's gone. That's what's starting to happen again right now. The physical metal is moving from weak hands to strong hands, from traders to holders, from the west to the east. And once it's gone, it's not coming back. Now, I want to take a quick moment here because this is important. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, and you're concerned about what we're talking about here, about monetary instability, about the potential for significant moves in precious metals, you might want to look into how gold IRAs work. I put together a free guide that covers the basics, how you can get physical gold or silver into a retirement account without triggering tax penalties, what the rules are, what the costs look like. It's in the description below. No obligation, just information. Worth checking out if that's relevant to your situation. All right, back to what's happening in the silver market, because there's another dimension to this that we need to talk about, and that's the geopolitical angle. We're living through a period of significant geopolitical realignment. The BRICS nations, Brazil, Russia, India, China, South Africa, they're actively working to reduce their dependence on the US dollar. They're settling trade in their own currencies. They're building alternative payment systems. They're accumulating gold and other hard assets. And while most of the attention has been on gold, silver is quietly becoming part of that equation as well. China, in particular, has been very strategic about silver. They're the world's largest producer of silver, mining about 110 million ounces per year. But they're also the world's largest consumer of silver, using about 200 million ounces per year, which means they're a net importer. And over the last several years, China has been steadily restricting silver exports while increasing imports. They're accumulating silver domestically. Why? Because they understand that silver is essential for their technological and industrial ambitions. Solar power, electric vehicles, 5G infrastructure, military applications, all of these require silver. And if you're China, and you're looking at a potential future where relations with the West become more adversarial, where supply chains get disrupted, where access to critical materials becomes a national security issue, you want to make sure you have adequate domestic supplies of silver. The same logic applies to other countries as well. India, another major silver consumer, has been increasing imports. Middle Eastern countries, flush with oil wealth and looking to diversify, have been buying precious metals including silver. Even some European countries, concerned about energy security and industrial competitiveness, are starting to think more strategically about silver supply. And here's the problem. There's not enough silver to go around if everyone decides they want to accumulate it at the same time. The market is simply too small. Total annual silver production is only about 830 million ounces. Total annual demand is already around 1.2 billion ounces, with the deficit being made up by recycling and above-ground stocks. But if investment demand spikes, if countries start accumulating strategically, if industrial demand continues growing, that deficit gets much, much larger. And that's when price has to do the heavy lifting. Price has to rise to the point where it rations demand, where it incentivizes recycling, where it makes marginal projects economically viable. But that price level is significantly higher than where we are today. Let me give you a historical parallel because I think it's instructive. In the 1970s, we had a similar setup in the silver market. Industrial demand was growing, investment demand was increasing due to inflation concerns, and the Hunt brothers famously tried to corner the market. Silver went from $6 an ounce in 1979 to $50 an ounce in January of 1980. A more than 8x move in about a year. Now, I'm not predicting that kind of move. The market is different today. It's larger, it's more sophisticated, there are more participants. But the fundamental dynamics are similar. You have growing industrial demand, you have investment demand starting to pick up, you have supply constraints, and you have a market that's relatively small and illiquid compared to other asset classes. And here's something most people don't realize. The entire silver market, if you add up all the silver that trades in a year, all the mining production, all the recycling, all the investment flows, you're talking about maybe $40 billion. That's it. That's smaller than the market cap of many individual companies. It's a rounding error in the global financial system, which means it doesn't take much capital to move the silver market. A few $billion of investment demand, a few large buyers entering the market, and you could see significant price appreciation very quickly. And that's exactly what some very smart investors are positioning for right now. I want to tell you about a mining executive I spoke with recently. This guy has been in the silver mining business for 30 years. He's seen boom and bust cycles. He's seen silver at $5, and he's seen it at $48. And he told me that right now, today, the silver mining industry is in the worst shape he's ever seen it. Why? Because at current prices, most silver mines are barely profitable. The all-in sustaining costs for primary silver miners are somewhere between $20 and $25 per ounce. With silver at $30, that's not a lot of margin. Especially when you factor in the capital expenditures needed to maintain production, the exploration costs needed to replace reserves, the environmental and regulatory costs that keep increasing. What this means is that there's very little new supply coming online. There are very few new silver projects being developed. The major mining companies are focused on gold, on copper, on other metals that offer better returns. Silver is an afterthought. And the primary silver miners, the companies that focus specifically on silver, they're small, they're undercapitalized, and they're struggling. This mining executive told me, if silver stays at $30, we're going to see mine closures. We're going to see production decline. And when the market finally wakes up to the supply deficit, when prices do start moving higher, it's going to take years to bring new supply online. You can't just flip a switch and open a new mine. It takes 5, 7, 10 years from discovery to production. So whatever supply deficit we have today, it's going to get worse before it gets better. And that's the setup. That's why this is so critical. Because once the physical market tightens to the point where the paper market can't function anymore, where the disconnect between paper and physical becomes too obvious to ignore, that's when things get really interesting. We've seen this movie before in other commodities. We saw it in palladium a few years ago when the market went into a sustained deficit and prices went from $500 to $3,000. We saw it in uranium when the spot market dried up and prices went from $20 to $140. We're seeing it right now in copper, where the physical market is tight and prices are pushing to new highs. Silver is next. The fundamentals are there. The setup is there. The only question is timing. And here's the thing about timing. You can't predict it with precision. You can't know exactly when the catalyst will hit, when the market will wake up, when prices will start moving. But what you can do is position yourself ahead of time. You can own the physical metal before everyone else realizes they need to own it. You can be on the right side of the trade before the trade becomes obvious. Because once it becomes obvious, once silver is making headlines, once everyone is talking about it, it's too late to get in at good prices. The premiums will be through the roof, the delivery times will be measured in months, and you'll be competing with everyone else who's trying to get their hands on physical metal. I've been watching the precious metals markets for a long time, and I can tell you that the current setup in silver is one of the most compelling I've ever seen. You have a fundamental supply deficit that's getting worse. You have industrial demand that's growing structurally. You have investment demand that's starting to wake up. You have a paper market that's massively leveraged and vulnerable to a squeeze. You have geopolitical dynamics that favor hard assets. And you have a price that, relative to gold, relative to other commodities, relative to the cost of production, is still very reasonable. This is not about speculation. This is not about trying to time a trade or flip for a quick profit. This is about recognizing a fundamental imbalance in a critical market and positioning yourself accordingly. This is about owning a tangible asset that has intrinsic value, that can't be printed or debased, that has thousands of years of history as money and as a store of value. And if you're holding silver bullion right now, if you've already recognized what's happening and you've already positioned yourself, then this is your confirmation. Hold on to it. Don't let short-term price volatility shake you out. Don't let the paper market manipulations discourage you. Because the physical market is telling a very different story than the paper market, and ultimately, physical reality wins. The people who understand this, the family offices, the sovereign wealth funds, the ultra-high net worth individuals who have access to the best research and the best advisors, they're accumulating physical silver right now. Quietly, methodically, without fanfare. They're not waiting for confirmation. They're not waiting for prices to break out. They're buying now, while the metal is still available, while premiums are still reasonable, while most people are still ignoring silver. And when the market does finally wake up, when the supply deficit becomes undeniable, when the paper market breaks and physical prices decouple completely, those who positioned early are going to be very, very glad they did. This is your final warning. Not because the world is ending, not because you need to panic, but because the window of opportunity to acquire physical silver at reasonable prices is closing. The fundamentals are deteriorating, the market structure is becoming more fragile, and the catalysts for a major move are accumulating. If you've been thinking about silver, if you've been watching from the sidelines, if you've been waiting for the right time, this is it. This is the time. Not next month, not next year, but right now, while you still can. Because once this market moves, once the physical shortage becomes acute, once the paper market loses credibility, you won't be able to get silver at any reasonable price. And you'll be left watching as one of the most significant wealth transfers in modern history unfolds without you. Don't let that happen. The information is out there. The fundamentals are clear. The setup is obvious to anyone willing to look. All that's left is action. And that action needs to happen now, before it's too late.